All right, Jason here again with another market update. Today is Wednesday, March 9th, 2022, and we've got a lot going on in the marketplace. We've got metals moving, we've got the market really coughing, struggling even from a week or two ago from when we did our last video. So I wanted to do a little bit deeper dive on what's going on in the stock market, specifically why things are struggling. More detail on what we can do about it, and a little bit of just kind of why we're doing these videos in the first place. So with that, kind of diving into the why, I started learning about the stock market really after talking with my grandma and learning about the Great Depression and understanding that there's this massive thing that happened financially and impacted her and a whole generation, and just really got me curious. And then 2001 was the stock market, the dot-com crash that impacted my dad. So, and then I experienced for myself in 2008, the Great Recession. And there's a lot of confusion, ambiguity around how the markets work. And it seemed like it should be less confusing. So kind of that curiosity is what drives me every day to understand things better. And really it comes from a motivation to protect my family. Is why we started Gratuitous Capital in the first place, was to protect the family. But if you're watching this video, we consider you part of our family, and that's why we're here to help you, inform you, share as much as we know, and together make better decisions when it comes to finance and investing. So with that, let's dive in. So stock market, we hit an all-time high around January 1st of the year. We are now 15% off that, and with not a lot of hope for it to get back there anytime soon. So why is that? Okay, kind of summarize, we covered the historic period we're in. Okay, we going back to the 70s, we looked at the M2 money supply increases there when we had inflation back in the 70s. Fast forwarding to today, or really March 2020, with the advent of COVID, we not only matched the amount of money we created back in the 70s, but we doubled, and depending on how long it lasts, tripled, quadrupled. We basically created more money in a shorter period of time than we ever had in the history of the world. And now that extra money is sloshing around, chasing the same amount of goods, driving up costs of everything. CPI comes out on Thursday. I expect CPI probably to be high 7s, if not hit 8% year over year. Another big increase, just simply based on the logic of all the money we created and how that inevitably impacts prices. Okay, so as we're talking about the market and all this stuff, the backdrop is this historic event that we are now dealing with. Trying to do our best to avoid the pitfalls, and if we do a good job, possibly accelerate through this. So with this historic event, all this extra money flying around, that's hitting CPI. So we're seeing prices rise. And what do the central bankers say when we see inflation hitting 7, 8, 9%? Well, the traditional prescription for inflation, to fight inflation, is to raise interest rates. And their intention is to raise interest rates above the inflation rate. That's what they did in the 70s and 80s. If inflation was at 15, they got rates up over 18%. My parents' first home, they borrowed 18% on their mortgage back in 1981-ish. Okay, so that all sounds great, all theoretical, but what does the actual impact have on the economy if we actually did that? The biggest difference from the 1970s to today is the amount of debt. In the 70s, our average debt to GDP ratio was like in the 30%. Today, it's at 130%. So basically, we have a heck of a lot more debt everywhere. Corporations, individuals, governments. We're drowning in debt. And we have historically low interest rates. So we're under 1% in many cases. If you borrowed a house recently, it was under 3% for a while. So it's been really cheap, which is great in the meantime. But if they go to raise interest rates, that is going to raise the borrowing costs for all of us, for individuals, for companies, for governments. And because the rate is so low, we're under 50 basis points, so we're under 0.5% for much of the government borrowing. It was as low as 0.1%. So even just raising it a quarter point, in many cases, can double, triple, quadruple the borrowing costs. So when it comes to the stocks, what does that do to your company's earnings? Well, you have a certain amount of profit, and you were paying maybe 5%, 10% for interest. What happens when rates double, triple, quadruple? Now your borrowing costs are going to eat up all your profit, and what's that going to do? It's going to hurt the price of your stock. And we saw that in the 70s. Here's an example of the stock market, 1965 to 1985 on a non-inflation adjusted basis. In the first bout, in the 1971 bout of inflation, the stock market traded off 40%. Then in 1974, they did another round of inflation, and boom, market was down 50, 60%. So if the market was down 40, 60% at a 15% inflation, what's it going to do at 28, 27% that we just did recently? That remains to be seen, but it's cause for concern. The second one here is showing, over the long period of time, stock market does do the 9 to 11%. We know that statistically. However, it does not mean we don't have 5, 10, 15, 25-year periods that it takes the market to recover. And when we're investors, our job is to preserve capital because it's really, really hard to get it back if we lose it. So yes, over periods of time, yes, you can ride it out through different markets. But if the signs are obvious that we're headed towards a correction, it's much better to avoid that in the first place. And this is indicated here showing the same chart from 1965, 1985 of the stock market. This one's inflation adjusted though. And what you see is a peak in 1968, around 850. And we didn't get back to that on an inflation adjusted basis past 1985, possibly into the early 90s. It comes off the chart here. The point is, it can be a very long period of time before you recover. And there are things we can do. A lot of advisors will tell you, this is what we do through thick and thin. That does work most of the time. We're in an environment, though, where we need to think outside the box. We're in a historic event, so we need a historic solution. This chart here is just showing the average borrowing cost from 2008 to 2022 for AAA rated corporations. Okay, we were borrowing above 3% here back in 2019. We experienced a taper tantrum and the stock market reacted then. And through all this stimulus and stuff, rates have gone down to these historic lows that I mentioned earlier. And then as of the first of the year is when they really started talking about raising interest rates. We haven't done any rate rises yet, but just based on the conversation, the borrowing costs have already almost doubled in a 30 to 60 day period. Okay, so this is showing the borrowing costs spike, right? So now let's look at that relative to the stock market, right? We have again, the effective yield, the borrowing cost compared to the S&P 500 on an index basis, going back to 2013-ish. All right, and what do you notice? When rates rise quickly, the stock market goes down. Again, for the same reason we just said before. The higher our borrowing costs, lower our profits, hammers our stock. So you see this rate rise here. This is showing this most recent increase in rates. And this is even week by week, this matters. Like when we pull data, this is from a week ago or 2 weeks ago, mid-February. That's when the market was down just a little bit. It's even further off now. And again, it makes sense. You increase your borrowing costs, you hammer your profits, and you stress out the stock values. And what we know historically, markets don't correct softly. As I've studied all the different market corrections, a 50 to 60 to 70 to 80% sell-off is totally normal during one of these crashes. Stocks tend to overcorrect, so if the market should be down 20% or 30%, you can easily double and sometimes triple that to what it actually bottoms out at. And it can be very short-lived, but certainly doesn't make the roller coaster ride any more fun. And in many environments, it is avoidable. You can see it coming, and there's things you can do to hedge yourself, to protect yourself from those big corrections. Because as we know, if you have $1 invested and you lose 50%, you're down to 50 cents. It requires 100% return just to get back to where you were at. So Warren Buffett has 3 rules of investing. First one is don't lose money. The second one is don't forget rule number 1. And the third one is I don't remember. And the point is it's very important to preserve our capital at all costs, especially when we know it's at risk. And if people are telling us or they don't have a plan for this type of environment, we should probably look for different advice because it's really important. There are things you can do. Don't let anyone tell you to snow you over and tell you there's nothing you can do and just ride it out. That's not something we recommend for ourselves, and it's the type of advice that got us in this business in the first place. So, okay, what can we do? That's the fun part. What's the actions, the steps that we can do to protect ourselves, and if we do a good job, prosper? Again, just to reiterate, this is a historic event. It's a historic time. The amount of money we created and the amount of time we created it is truly something we've never experienced. So thus, a historic action is required. The 2 things to summarize are really the idea of capturing gains. Equities have had a tremendous run from 2008. Great time. It used to be great, like even a week or 2 ago, it was a better time to exit, but it's still a reasonable time to get out of equities and look at different allocations. We see, honestly, the chance for up to an 80+% correction. That's what we're concerned about. We don't predict the future. We're not in that business, but that is what we're concerned about. And there's things that you can do to position yourself. So even if that does happen or doesn't happen, you're still doing great. So consider taking gains in equities. Bonds, honestly, for the last 30 years, I would never own a corporate bond. So if you do have them, it's also a time, as interest rates rise, bond values fall. So if you want to lend directly to people and earn a higher percentage, that's an option, but I would never own corporate bonds. Capture gains there, and then buy real stuff. Buy things they can't print. Multifamily, commercial real estate, direct owned, any kind of business that's their profits are derived from energy or commodities, that's also a potential place. And as we mentioned, precious metals. They've been tremendous hedges against inflation, and you're starting to see it. We did the research back in October, November, and we're seeing a little bit of that correlation. And even in the last 2 weeks, the correlation where people are dumping their stocks and buying commodities has been almost a 1-to-1 ratio. You see the stock market up 3%, metals are down 3%. But it's been happening in reverse. If the stock market's down 2-3%, you're seeing all that money flow right into commodities. In a very surprisingly high correlation, how direct of a correlation it is. So we believe that we are in the first inning, maybe 1 out, 2 outs of a 9-inning game, and this is just beginning. We shared this slide in the last one too. This is just showing the M2 money supply creation, all that money expansion since 1971, and how gold and ostensibly silver have kept pace with that money creation. So these precious metals are known as money. A lot of traditional financial advisors and traditional advice is trying to get you to minimize gold and silver, pretend like it doesn't exist. But it's actually not only kept pace with inflation, but it's averaged 8.1%. If you had asked me over the last 50 years if gold was within 1% of the stock market return, that truly floored me when I found that out. So gold is a tremendous hedge against inflation, and silver trades right in tandem. Gold tends to lead, silver tends to lag a little bit, but silver also has industrial demand as well. So not only does it have monetary demand, but it has industrial demand, which tends to rubber band it to catch up to gold. And we see more potential in silver than in gold, but they're both great places. Personally, I like 80-20, is roughly what I am, 80% silver, 20% gold, roughly speaking. And just to show a little bit about types of dynamics that we see in the market, this is literally yesterday, March 8th, 2022. This is the chart of nickel. Most people probably I don't follow this market that well, but I heard this. Nickel was sitting about $20,000 per ton. And in about a 24-hour period, it went from $20,000 to $80,000 to over $100,000. So a nickel actually in your pocket at the height here is worth 11 cents. So if that stays that way, you're going to see a lot of nickels coming out of circulation into people's pockets, get melted down and turn into, that's what happens in this inflationary period. And there's just some of the things, we don't know exactly when the money, when inflation happens, you got all this extra money and it sloshes around and it hits these different asset classes. You never know what it's going to hit and when, but you kind of know where it's going to hit everything. And if it hasn't hit an asset yet, then there's a good chance that wave is coming. And that's where we see gold and silver still today. Gold's at all-time highs, but it hasn't really had that major punch that we expect. And silver is very similar. But this is how it plays out, and it can play out fast. So there is a certain sense of timing to all this, not to hurry. Do your research, pray about it, really make sure you feel good about any changes that you're making. But time is important, and that's part of why we're getting these videos out, to help you make as informed decision as possible. Again, coming back to the real estate side, this is a graph, just kind of represents an average deal that we look at on the commercial multifamily real estate side. Along with commodities. Basically, apartments are commodities that cash flow. Think of it, bricks and sticks that have renters that generate income. So it is a commodity-based business that also has a rental component that even differentiates it from precious metals because of the income. It's unique. In a normal environment where we only have 3% inflation, it's a great steady return, 10% on an annualized basis, more than doubling your money. If you put in $1 over the 10-year period, you get about $2.50 back, okay? That's in a normal period. In an inflationary period, this is just 6%. We're obviously headed to higher than that, but showing 6% over a period of time with only a 3% increase in the growth rate or the inflation rate on both the income and the expense, you see a 44% increase in the return. So going from 10% up to 15%, getting to a targeted equity multiple of 3 instead of 2.5. And over a period of time, it's pretty significant. Just the unique thing, all businesses are impacted differently by inflation, but real estate is one that benefits the most because it's able to raise its income along with inflation. So when we were first getting into the business, this is the question we were asking ourselves. As we learn more about how rental real estate works, we asked ourselves, where else can you get this? We oftentimes will see equity-like returns, 9, 10, 11, 12%, with meaningful cash flow, beating dividends by double, triple sometimes, and also a heck of a lot less volatility. When the market's down, if you drive by your local apartment building, say the stock market takes a 50, 60% crash, do you think the apartment owner who you drive by cares? No, because their costs are fixed, their income's still coming in, they're good to go. So these are big reasons why we got into the space and why we're excited to share about it with others. And we're not the only ones. This is an example, Blackstone, one of the world's largest asset managers. They've got, I don't know, $6 trillion or something of assets under management. They're one of the biggest and best in many cases. They're not dumb. They understand what's going on, the dynamics. And they're so big, though, that they can't buy individual properties. They'll just go in. They got $6 billion to spend. They buy entire real estate investment trusts, giant pools of buildings. They just come in and buy the whole company. They've done 3 of those deals in the past 3 months. This is February 17th, 2022. So that's showing you the big money is paying attention. So getting into action plan. What can we do to protect ourselves? We see this, again, as a historic event, and we need to take some action, but we're really talking a 12 to 36 month plan. A lot of that depends on what we continue to do from a policy perspective. Based on the money we already created and how that sloshes through the economy, that's 12 to 24 months. That's kind of where that comes from. If we continue on these policies, we have another 12 months on that. But it's a short period of time relatively short period of time that we're looking at. And the goal of our plan here is for sure to weather the storm well. But if we do a good job, there's a good chance we accelerate. If we get into some of these asset classes ahead of the crowd, we will benefit tremendously from that, and we can actually increase our purchasing power through the choppy waters. And that's an important term. Like, we see this, there's going to be a lot of things going on in the economy. There already are, and we think there will continue to be. But we call that choppy. If we know what we're doing and why we're doing it, the goal is to reduce fear, reduce worry, and if we have a plan in place, then we can feel good about where we're headed. All right, so with this plan, there's two different ways to look at the buckets of money that we have. We're going to talk about where the money's coming from, and then we're also going to talk about where it's headed. And where it's headed is these 3 buckets. You basically have your super short-term cash liquidity needs. Call that your 3 to 6 month, your emergency fund, your reserve fund. Same holds true for household or business. You have a certain amount of money that you set aside, and it sucks, it's not working for you, but you need it so you don't stress about your day-to-day needs. And you have margin, right? So first fill up that bucket, and then you have these 2 other buckets. Short-term kind of inflation hedges, and your long-term stuff you do kind of regardless. So with the short-term stuff, that's where out of our short-term bucket, kind of 12 to 36 month time frame, that's where we would consider. Normally we would not do these precious metals and commodities plays. The only reason we're doing that is because they've created so much money that our dollars are just sitting around making nothing, and they're really at risk if we don't do something. So that's that bucket, precious metals. We also do put crypto in here, and we added be careful, very careful. It's a whole nother video. Crypto will benefit from inflation. There's no doubt about that. Where it will end up 5, 10, 15 years from now is a whole nother discussion. And we do think there are some insights that you can glean to do well in that area as well. But that's where that would fall into the different buckets. Then you have your long-term stuff, 3 years plus, right? If you have money that's stuck in a 401k or stuck someplace and it has to be invested in something other than what we already shared, then you want to look for direct-owned real estate options, real estate investment trusts, anything energy or commodity-based equities. And we'll kind of touch a little bit more on 401k, IRA, where all this money can be housed and what's the flexibility within those different vehicles. So cash obviously is your most flexible. Fill up your emergency fund, and then cash, like you can do anything with it. IRA is the second most flexible, but there are plenty of self-directed IRA options. You can pretty much invest in almost any investable asset, metals and real estate, and even like certain like wine and certain things like that you can do. I don't recommend that, but there's a lot of flexibility there, and there's different custodians that specialize in different areas. Feel free to direct message us or ask that someone on our team can help you. We basically had to solve all these problems for ourselves, and so that's really what we're sharing is what we've learned through the process. I myself had a 401k with very few options that were inflation friendly. So 401k money tends to be the least flexible, most captive, hardest to get at. But there are a couple options. One is a loan to self. I did that. You can borrow up to, I believe, $100,000 or 50% of the value of your 401k. I took those funds out and moved those out into some metals. Another option is if you have worked for someone else and you have that employer's 401k either still there or at the new one, you are able to roll old 401ks out into an IRA, giving you more flexibility to do the self-directed option. Also, just something to check on, it's a low probability, but sometimes they do allow you to take money out based on the plan itself. Most plans don't allow you to take money out, but it's possible, so it's something you can ask about. All right. But after you've pursued all those options and you still have money in the 401k, 401ks are not designed to help you in this type of environment. They're designed to keep you invested fully the exact same way through every environment. In fact, they have funds that are just like 2050 funds, and it's supposed to be everything you need to retire at 2050. May do that, it may not. But what we recommend, if you do have funds in there, I myself moved everything into a money market fund. That's the closest I could find to cash. Then later on, I did discover that we had a real estate fund, so I moved a good chunk into that. And there's also energy or commodity type equities, stocks that also should retain their purchasing power and if not grow through this time frame. So those are some things on the 401k to consider. Again, we have had to solve a lot of these for various family members and partners and things like that. So if you have any specific questions, feel free to reach out. One of the things people asked on the metals side is where to buy from. So I found online tends to be your absolute best pricing. If you got a local dealer or something where they can match online pricing and you can go and pick it up, that can be a good option. I just haven't used that yet. Sales tax, though, is definitely something to consider. They now charge sales tax on all precious metals, or most of them. So if you can find a state or a family member in a state that doesn't charge sales tax, it's a great way to take delivery through family or whatever. And that's the metal side. There was something else there, but that's okay. We'll move on. With all this, if you have questions, feel free to reach out again, direct message us. There's a lot going on in the market. Time is of the essence. We say we don't want people stressed out and worried about this. But there are dynamics taking place real time, and we don't see the stock market getting too much better priced for the next 6 to 9 months. So if you do have equity exposure, it's definitely something to talk to advisors, think about, pray about, do your own research on all of these things. Take them before the Lord and ask, what makes the most sense for you and your situation. But if you do get advice from people that aren't thinking about the dynamics taking place in the market, that don't have a plan for inflation, then I would look for better advice or different advice. That's what I'd have to say on that. So thanks again for sharing this time with us. Again, if you have any questions, like direct message us, or put them in the post so that we love to hear feedback and things that resonate or make sense, or any kind of questions you have that just helps us come out with the next video that's more on point. So with all that, thank you very much.